Here's something that doesn't get talked about enough in retirement planning. Disorganization might cost you more than a bad investment ever will. You did everything right, you saved, you invested, you built real wealth. And in a worst case scenario, that disorganization could cost you over $500,000 in foregone retirement savings over 30 years. Not to the market, not to bad advice, to something hiding in plain sight. And it's this. According to Capitalize and the Center for Retirement Research, Americans have left behind $2.1 trillion with a T in forgotten 401k accounts. And those forgotten accounts, well, research suggests they could potentially cost some people $500,000 over 30 years. Here's what nobody tells you. The strategy that got you to retirement is not the strategy that gets you through retirement. Today, I'm going to show you the 3 hidden costs of a messy retirement and 5 concrete steps to fix it. You can't protect what you can't find. There's also one cost that has nothing to do with money. I'll get to that around the 4-minute mark, and it might be the most important part of this video. So here's the irony. Being good at saving can actually make you terrible at retiring. You got rewarded for responsibility with chaos. Congratulations. The Bureau of Labor Statistics found the average American born between 1957 and 1964 held 12.7 jobs by age 56. Every job potentially left behind an orphaned account. A 401k here, a pension there, maybe a deferred comp plan you forgot existed. Nobody planned to have 7 accounts at 6 different institutions. It just happened. I call this complexity creep, and now it's working against you. You're essentially flying a plane with your altimeter in Dallas, your fuel gauge in Chicago, your navigation in New York while trying to land in Miami. So if you've ever opened a statement and thought, wait, I forgot I had this, you're not alone. Drop a comment below, by the way. I see it all the time. Before I show you what this chaos actually costs, let me tell you exactly what we're going to fix. By the end of this video, you'll have 5 steps. 1, a master inventory so you can finally see everything. 2, a consolidation strategy. 3, a tax bucket framework. 4, a framework for a spouse protection document. This is one of the most often skipped items, and it might be the most important. And then 5, an annual system to keep it organized. I'll walk through each one starting around the 6-minute mark for you, but first let me show you why this matters so much. Let me give you the numbers. Capitalize estimates Americans lose up to $150 billion annually to forgotten or poorly organized 401k accounts. And that's not market losses. That's fees and suboptimal returns. Basically, silent wealth destruction. So here's how it happens. Orphaned accounts often sit in default investment options that may not align with your goals. For example, some may end up in money market funds, earning very little while still charging fees. A forgotten 401k with $66,000, the average balance of these accounts, in a hypothetical scenario over 25 years could have grown to over $300,000 at 6.5% annually. If funds were sitting in a money market at 0.5%, your $66,000 only grew to around $75,000. And that's not a rounding error. That's a significant gap that proper organization could help address. Stay with me for 40 seconds. This could be worth real money. Have you ever heard of asset location? Not allocation, but location. Where you hold investments may matter as much as what you actually hold. Research from Vanguard and Morningstar suggests that proper asset location plus strategic withdrawal sequencing, meaning which accounts you withdraw from first, could potentially add up to 185 basis points. That's 1.85% annually for some investors. And these are not guarantees, but they are potential outcomes based on research. So here's the point. Organization isn't just tidiness. It may be part of your overall strategy to preserve what you have built. Now, we're going deep on tax-efficient withdrawals in a future video, so be sure to subscribe to our channel if you don't want to miss it. Now, this is the one I mentioned at the beginning, the one that has nothing to do with money. Here's a question I've asked hundreds of people over the years. If something happened to you tomorrow, could your spouse find everything? Every account, every login, every beneficiary. Most people go quiet because the answer is usually no. And here's what the research says. According to a 2024 Thrivent survey, 41% of widows had no financial conversations or plans in place before their spouse died. 61% couldn't file their own tax returns. And here's a statistic that stopped me cold. 70% of women leave their financial advisor within the first year of their spouse's death. And not because the advisor was bad, because the relationship was with the husband. A surviving spouse dealing with grief shouldn't have to become a forensic accountant. You can't protect what you can't find. Let me tell you about a common situation, and I'll use a fictional couple named Tom and Linda to illustrate the point. Tom had done everything right. 35 years, 3 companies, maxed out his 401k every single year, built a portfolio of about $2.4 million. But when he came to us, it was scattered across 11 accounts at 8 different institutions. Statements in 3 different filing cabinets, 1 envelope from 2017 still sealed, an old 401k from a company that had been acquired twice. He'd forgotten about $187,000. And Linda, well, she knew about maybe half of it. When I asked her if something happened to Tom tomorrow, could you find everything? She looked at Tom looked at the floor. Nobody said anything for about 10 seconds. We spent 3 months, consolidated 4 old 401ks into 1 IRA, created a clear inventory, built a system they could maintain together. A few months later, Tom said something that is hard to forget. He said, "I sleep better now." Not because his portfolio changed, but because he could finally see it. That's what organization gives you. Not just clarity, but peace of mind. Now here's where I'll say something you might not expect. Something most retirement advice gets completely backwards. Most people think organization is about relaxation, peace of mind, sleeping better. I think that's only half right. Here's what I've personally seen in 20 plus years of doing this. Organization isn't really about relaxation. It's about permission. According to the Allianz Life 2025 study, 64% of Americans fear running out of money in retirement, more than they fear death itself. And research from David Blanchett and Michael Fink found that a married 65-year-old couple with $100,000 in assets actually withdrew only 2.1% annually. That's half the 4% rule, if you're familiar with that. They saved so well, they're afraid to spend it. Delayed trips, skipped gifts, not because they couldn't afford them, because they couldn't see that they could afford them. When you can see everything clearly, when you have a better understanding of how long your money may last, you give yourself permission to actually live. That's what organization is really for. Not just to survive retirement, to actually enjoy it. All right. You've seen the costs. Now let's fix it. Grab a pen if you want. Here is the 5-step framework. List every account you have, everything. 401ks, current and old IRAs, brokerage, banks, pensions, annuities, life insurance with cash value, HSAs. For each one, document institution and phone number, account number, current balance, beneficiary designations. This one matters more than people realize, by the way. Login credentials, stored securely. This takes an hour or 2 and puts you ahead of most retirees. You can't organize what you can't see. So have you done this, or is it on your someday list? Comment below. I'm curious just to hear what your situation is. Now, once you see everything, ask, do I really need 7 accounts at 6 institutions? often you can roll old 401ks into a single IRA. More options, potential for lower fees, one less statement. And now here's where I disagree with a lot of advisors. Many will tell you to consolidate everything, roll it all into one place. That's not always right. Some 401ks have institutional share classes cheaper than anything in an IRA. Some have creditor protection that disappears when you roll out. And if you're 55 to 59 and a half, the rule of 55 lets you access 401k money penalty-free, but not if you roll it into an IRA. The point isn't to consolidate blindly. It's to make an intentional decision about each account. This is where things get strategic. Organize into 3 buckets. Bucket 1 includes tax-deferred accounts, traditional 401ks and IRAs, or a TSP if you're a federal employee. You'll pay ordinary income tax when you withdraw. Bucket 2 includes tax-free accounts, Roth IRAs and Roth 401ks. These are the qualified withdrawals, by the way, are tax-free. And then bucket 3 includes taxable accounts, regular brokerage accounts or trust accounts. You'll pay capital gains tax on growth when you sell. Now, why does this matter? Well, in retirement, you choose which bucket to draw from. That choice can significantly impact your tax bill, though, of course, individual results vary based on your specific situation. So now having a clear view of all 3 buckets really equals the foundation of tax-efficient income. So remember Tom and Linda, remember that 70% statistic, widows leaving their advisor. Here's how you fix it. Create one document, physical or digital, that includes all accounts with contact info, location of important documents, wills, trusts, policies, key advisor contacts, financial advisors, CPA, attorney, access instructions, brief overview of your strategy. Then, and this is critical, review it together. Walk through it. Make sure they know where it is. Update it annually. This isn't just organization. This is an act of love. If you're thinking about your spouse right now, here's what I want you to do. Screenshot this step, text it to your spouse with one question. Could you find everything? That one conversation might be the most important thing you do this year. Organization isn't a one-time event. It's a practice. Pick a date, birthday, New Year, anniversary, schedule a review, update your inventory, verify beneficiaries, check allocation, refresh the spouse document. 2 to 3 hours a year keeps everything simple, year after year. And honestly, this is a lot less painful than doing your taxes and more emotionally rewarding. So remember, step 1 is master account inventory. Step 2, consolidate, but don't do it blindly. Step 3 is organize by tax treatment. Step 4, create a spouse financial inventory. Step 5, schedule an annual review. Follow these 5 steps and you can work toward a simpler, clearer, more organized retirement. And if you found this helpful, go ahead and subscribe to the channel. We go deep on these topics every week. Once you've done this work, you can finally answer the real questions. When should you start Social Security? How much can you safely spend? Which accounts do you draw down first? Are you on track? Organization doesn't answer those directly, but it makes answering them possible. If you want help building this for your specific situation, especially if you're managing $1 million or more in your portfolio, go ahead and click the free retirement assessment link below in the description, or visit our website at covenantwealthadvisors.com. We're fee-only fiduciaries receiving compensation from advisory fees only. No commissions, no products, just straightforward conversation. And remember, all investing involves risk, including potential loss of principal. So here's what I want you to remember. You can't optimize what you can't see, and you can't protect what you can't find. Thanks for watching. We'll see you next time.